One of the many benefits of being a Motz Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the Forecast 2014 Past and Present event is Melissa Motz, President of Motz Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on January 29, 2014.
Thank you everyone for coming out tonight. It's a good excuse to get out on a cold winter night. We were really blessed this week because the snow gods smiled on us, and it snowed really early in the morning and not tonight, or no threat, so easy to get out tonight. So thanks everyone for coming. Our next event is our client conference call on May 21st, and then we're going to have our halftime report here in July 30th. So we'll send that out to you. Yeah, just think July. Here we are, snow. It'll be nice and warm and, long days, beautiful weather. And then I also wanted to thank those of you that brought a guest tonight. It's a great way to introduce someone to Motz Wealth Management in a nice, friendly, relaxed environment. And if someone you know of that you'd like to introduce to us but can't come to one of our events, I'm glad to set up a lunch or dinner or whatever to meet with them separately with you. So just casual and relaxed. And I want to have also offer a special thanks to our sponsor. He's not here, but he's paying for everything tonight. John Napoleon from Realty Capital Securities. So thanks, John. Yeah. Okay, where we've been. So 2013. Basically what we saw was the riskier the assets, the more money you made in 2013. The less risk, the less you made or lost. So we had the S&P up 30%. The yield on the Treasury was at 3% at the end of the year. At the 10-year Treasuries, gold down 28%, emerging markets down 8%. And something interesting, so Treasuries, U.S. Treasuries, I just pulled something out here, 30-year Treasuries. So, the federal government auctions off the bonds, and some of them are 30 years. And a lot of those rates are used in pension calculations and so forth for a lot of companies. The value of the 30-year U.S. Treasuries went down 17% last year. Yeah, so big decline. And 10-year Treasuries, the value went down 8% last year. So some experts' opinion, so from the middle of the year till now, were that preparing for rocky terrain, but actually the S&P went up 14% from the end of June. Also called for an uptick in volatility, but actually the volatility went down 26%. So it's just kind of showing you how experts say something, and we just don't know, which is why we diversify. And we're not out of the woods yet. BlackRock, Byron Wien, said gold was going to reach 1900, and it didn't. S&P would fall below 1300. Harry Dent, I don't know if any of you remember him. He did The Great Boom Ahead. It was a best-selling book back in the 90s. And he had a new book out, not this year, but a few years ago, saying The Great Bust Ahead. And he was expecting the Dow to fall below 5,000. So he was way off. And the average Wall Street bank put the S&P at 1543. So, much lower than what it ended up finishing. You can see Merrill Lynch and UBS predictions. And David Tepper, guys that are short, so they're short meaning they're betting against the market, he said better have a shovel to get themselves out of a grave. So he was right on. It was a really big year for stocks. So 2014 outlooks is what we're seeing here. So we can see the low, Deutsche Bank, 1850, which is pretty much where we started the year. So calling for a flat year, all the way down through Barclays, Goldman Sachs, seeing a little bit higher. Citi, Bank of America, Merrill Lynch, 2000, Morgan Stanley, 2014, and JP Morgan, 27.5. So we'll look at this. We'll break it down and see. So we can see the percentage that they're calling for an increase. And so far we know we're down this year. I think mostly everybody knows that we've been down in January so far. So this is a really interesting chart. It's hard to see because there's so many numbers on it. Basically what we're looking at, there's 14 blocks here. All the red ones are years when the stock market declined. And the green ones are all the years when the stock market went up. And the first block in the center here is down 0 to 5%, or the one next to it is up 0 to 5, and then it goes in 5% increments all the way down to greater than 30% on either end. Okay? So the thing I'd like to point out is, if you look at the number of times the market was up, first of all, many, many more years that it's up than down. And then also, if we look at 30%, which is about what we had this year, increase, many years. There were a bunch of years where we had that much. A bunch of years where it was up between 20 and 25%, where it was up 10 to 15%. That's the highest one right there. A lot of years. And the years up over 30%. I mean, a lot of years up over 30%. And a lot less that were down over 30%, or down between 25 and 30%, only a couple years. So we've got a lot of years where it was up. But we see like 2008, we all remember that year. That was a big down year. The bear market prior to that was, 2000 and 2001, both years down between 10 and 15%. And then 2002 was down between 20 and 25%. So we had 3 years in a row down there. But then we've had other years where it's, especially in the 90s. We had like 99 was a really good year. 1995 was a really good year. 1997, 1998. So we've got a lot of in the 90s where, it was up on the positive side. Okay, and Ben Bernanke, he gave his last, it's the end of the month, but today was the last time he was giving the report that he does for the Federal Reserve after their meeting. So the Fed announced tapering, so they're going to stop buying so much, and they did follow through with that today. So this slide was prepared before today, obviously, and they're following through with reducing what they're doing. And I just have a quote from today's Fed report that they left unchanged its statement that it will probably hold its target interest rate near zero well past the time that unemployment falls below 6.5%, especially if projected inflation remains below the committee's longer run goal of 2%. There's a lot of speculation about, oh my gosh, they're tapering, it means interest rates are going to go up, but that's not necessarily true. And interest rates are, when they go up, that's what kills business. I mean, that's what's been used in the past when the economy is running at too high of a speed or growing too quickly. Interest rates go up to try to cool down the economy. But they're not really talking about raising interest rates here. Not for a long time after they reach their target, and their target is, they taper. So in my view of it, they're slowly reducing the amount of bonds they're buying back. So that's a good thing. They're seeing how is it going to affect things. They cut it back some. They see how it affects things, then they'll cut it back some more, and they're watching the data. So if the data doesn't prove out, and the economy starts to retract, then they won't necessarily taper. So I think it's being done in a nice measured, gradual way. So I think that's a positive, is my, opinion about that. We'll see. We'll see how that goes. And we also have, we'll see in another slide here, Europe, they lowered their rates. They're copying us close to zero, now too. So, Bank of England and Japan are doing a lot of bond buying and printing money. So there's still a lot of money being put out into the world economies. So here's our new chairwoman, Janet Yellen. Yes, the first chairwoman of the U.S. Federal Reserve. And she is, very dovish, like Ben Bernanke, meaning accommodative, willing to step in if the economy is running into trouble to, provide liquidity, provide money out there. So that's a good thing, in my opinion. The government shutdown that happened, at the time it was very dramatic, but in the rearview mirror now, with some perspective, it was really more of a speed bump, And actually, since 1976, there have been 17 government shutdowns. So even though one hadn't happened for a long time in our memory, there have been quite a few. And the longest one was during that would have been Clinton, I believe, 95 to 96. And then we had the U.S. debt ceiling right after the government shutdown. That ended up being, they extended it, So I guess what I'm trying to say is that, I can't see anything on the horizon that's going to, put a big hammer down on things, We reach these impasses with Congress where they can't come to a decision, but then when push comes to shove, things get done. Things get done. I'm not saying that that's right, but I'm saying that they're not willing to crash the economy. At least that has not been the case so far. And the debt ceiling was suspended until February 7th. So that's coming up next week. So after today with the Fed reporting, that'll probably be the next thing you'll start to hear, in the next several days about the debt ceiling. We've got a lot of debt. Actually, interesting to me, I don't know if you'll find it interesting, but today they do, you can go online and see when they do the auctions of the government bonds. And today was the first time they issued floating rate debt. So our government is issuing floating rate debt now. Okay, it's not just fixed rate. So it's just like if you had a floating rate mortgage or you had a home equity line of credit that can go up and down. That's what they are now. So they're a borrower. The federal government's a borrower, so they're just like us. If we take out an equity loan on our house, we're borrowing money at a floating rate, thinking rates won't go up, so it'll be okay. I can get that paid off or whatever by the time, in a period of time and get a lower rate. And the government's doing the same thing. So our federal government, essentially, by buying back all those bonds like they did, they locked in extremely low rates for themselves on the long term, 10 years, 30 years. So they're doing the same thing we as consumers would do if we had a mortgage and we refinanced at a lower rate and locked it in for a long period of time. So that, that's a good thing. And now they're issuing floating rate debt. So do they expect inflation to really heat up a lot? I don't think so. I don't think so. You wouldn't put yourself on the hook if you think rates are going to go up to have your rates go up in the future, by issuing floating rate debt. So I think, those are good signs. And the other good sign is they had over 5 times the number of subscribers wanting to buy the debt than they had. So there's a lot of demand for it. So that's a good thing too. So consumer spending. The economy, the GDP was revised twice upwards. And then we don't have the fourth quarter numbers yet, but the third quarter up 4.1% annual rate, which is much better than most people predicted for last year. Personal consumption is showing significant improvement. What is on the right-hand side there, those bars, are showing what contributes to our country's gross product. It's like if our country was a company, what is making up all of the the spending that's going on, and it's private investment. Personal consumption is a big percentage of it. Exports, government, and then imports are declining. So I don't know if you remember, but years ago, do you remember all the trade deficit talk? Oh my God, our trade deficit's going up and so on. You don't even hear about that anymore. Do you notice? You wouldn't necessarily notice because you just don't hear it. But yeah, our trade deficit is going down, down, down because we're exporting energy. Okay? That's a good thing. That's money coming back into our country. All that money left and went to the Middle East over, decades. It's coming back. So there are a lot of really positive things, that are going on, but you don't necessarily hear about those. They're not newsworthy. Unemployment rate does continue to decline, so that is a positive. However, the labor participation rate is near multi-decade lows. So what that means is the percentage of the labor force that's actually looking for a job or participating. As part of that, we do have the baby boomers, getting to a certain age and retiring. The one good thing about that is if things start to heat up in our economy, we have people that can come in and get jobs, So we're not from a supply and demand standpoint where you can have, not enough people to fill the jobs and then the wages need to go up to attract people. We're not in that situation. So inflation I don't see as being an issue, going forward. Wage inflation I don't. And then we have this little cartoon here, which is kind of ironic, but it says, Celeste, what's it like to be working after 3 years of unemployment? Like a kid again. Is that because you do a lot of birthday parties? It's because I make the same hourly wage I made when I was 15. So the wages are stuck, unfortunately. They're not going up, and, it's supply and demand. If there's plenty of people wanting to do the work, then you're not going to get a big raise. And then this kind of shows it here. It looks like you're going up the stairs, but actually you're just going in a circle. Low quality jobs, wages stuck. But we are seeing, we have been seeing an increase in manufacturing here. And those jobs typically will pay, more. We're not seeing the jobs like, I just use Merck as an example because that's a big employer here that's cut a lot of jobs. Same thing with, a lot of pharmaceutical companies in the area. Those jobs we're not seeing, being recreated. But there are jobs in some industries and in certain parts of the country, especially related to energy. A lot of jobs in those parts of the country. And we can see, so there used to be, used to get over 3% raise, 4% raises, 5% raises, now it's 2%. I'm looking at Micah sitting in the back there, so he just joined the labor force this past year. So, there were good old days we all remember, we used to get really good raises. And then home construction, if we look at that, we can see the housing starts. So we can see where they were back the beginning of 2008. That was before the housing market really collapsed, and how low they went and kind of hobbled down along that area there, and they've come back up close to where they were in 2008. Now they cut back some in December, and we don't know why yet. There's speculation because of the weather or whatever, but we'll see how that goes. But it definitely has been improving. And mortgage rates. So, this goes back to 1971. So we've seen a big increase in mortgage rates in, last, 6-7 months. But relatively speaking, our average over all those years is 6.71%. Look how low, much lower it is. That's that much more money people can spend on other things. It's, really a wonderful thing. Anybody remember the 18.45% mortgages? Can you imagine? Is that when you bought your house? Yeah. My first house was 12.5%, and I thought that was outrageous. This graph has kept the mortgage refinance industry in business, for all these years. Okay, so I've talked about that, inflation. It remains low, and it does allow the Fed to maintain an accommodative monetary policy. They are not going to raise interest rates if we keep this low inflation. It's just not going to happen. There's no incentive for them to do it. Why would they? That would squash our economy. Why would they? They talk about, the jobs. That's a big indicator, but their main goal is inflation, managing that. I thought this slide was interesting. It talks about what makes up CPI, because people say, food's going up. How can inflation be so low? I'm paying so much more for food or whatever. But you can see here, the biggest chunk, 40% of the CPI is housing. Okay, and that's not prices of houses. That is what it would cost to rent. Okay, the equivalent rental value of a home, or an apartment or whatever space. So that's a big part of it. And then transportation, we can see that's a pretty good size. And really, gas prices they went up, they came back down. They've been, and we'll see a slide, about that. So that's a big percentage. And that's not just gas prices. It's diesel. It's a lot of trucks have been converted to natural gas and so forth, fleets and everything. So with our energy, boom, that has really kept those costs down. And then food and beverage, that's the one we all really know really well because we do that a lot. We're shopping every week for food. You're not shopping every week for an apartment or anything like that. So that seems more in our face, but that's a small part, much smaller part. That's the dark blue. And you can see what's increased and what hasn't year over year. And the net worth of Americans is higher than ever before. So the biggest thing to me about this is the percentage of debt that people have now has gone down dramatically. It's back down to as far as the percentage of what people spend their money on in regards to debt, like debt as a percentage of their expenditures, is down in 1980s levels right now. So the consumers have done a really good job of paying off their debt over these last several years. So that's a really good thing because then that allows more money for consuming things. And then there's pent-up demand because they've been paying down debt, so they haven't been, replacing things or buying things. They've been making them last longer. So, we've got that potential there. So the S&P rally has outpaced earnings growth, which is expected to only slightly accelerate in 2014 and 2015. I just pulled out some headlines from Toyota Motor Company today. Announced it produced more than 10 million vehicles worldwide last year, first time any automaker has ever manufactured that many vehicles. And their stock was up 2%. When I saw it, I don't know what it ended at. Ford Motor Company, their fourth quarter profit jumped on strong results from North America and Asia. Their pre-tax, their net income rose 90% in the fourth quarter. But they're giving guidance that, don't expect it to be so good next year. So then that causes the price to go down. So it's down 2.89% today. And then we have Boeing. They easily beat their forecasted earning growth. And their stock was down 5.8%. So, it's just really interesting how, you beat the earnings and you're doing really well and your stock drops. Yeah. And then Dow Chemical. Stock was up a lot today, over 4%. And they've been under pressure from an activist investor, Daniel Loeb. They reported a profit following a year ago loss. So they've turned things around, a lot of cost cutting and so forth. So European stock markets, see, Ireland did the best last year. Greece, look at Greece. Well, when you're down here, 24% doesn't take you that high, The thing it tells me is you don't count anybody out, There's always that human nature to want to do better, be better, have a better life, have a better life for your children, etc. We don't necessarily hear that on the news because we might hear the protests and all that kind of thing, but there is definitely some positive news. And then the European Central Bank, lowered the rates towards zero last year. That was a big deal. They resisted that for a number of years, and finally, I think especially as a result of the Germans, gave in on that. And then we have China. So their economy supposedly grew 7.6%. Their data is always suspect. A slight slowdown is being shown there. But their purchasing managers index just came out. It fell below the growth rate, below 50, which is not necessarily a good thing. But still growing. I mean, it's growing faster than our economy. And I thought there was an interesting tidbit on China. Back last year, and I missed this, they've had the policy for one child policy for over 30 years. Well, now it's 2. Yeah. So that's a big change. They're facing a demographic of, all these elderly people with not half the kids, to be able to support them. So they needed to do that. So it shows you even China, they can make changes in policy and so forth in response to what's going on. So what to watch for this year? Watching the Federal Reserve exit their tapering. But again, I really don't think they're going to be raising rates. I can't fathom them doing that. Money flows, revenue and earnings growth, politics, of course, that's always something to watch, and geopolitical tension. So the Fed exit. So when this slide was made, the question was, interest rates continue to rise. Well, actually, they fell down. They were at 3% at the end of last year, and today the 10-year was 2.7, below 2.7, okay, in less than a month. So, you think, oh, yeah, rates have to go up. No, they don't. No, they don't. So what's happened is the conservative investments have done well. Aggressive ones have not this year, so far. And then emerging markets, we're definitely seeing pressure in emerging markets this year as a result of currencies more than anything. There have been a lot of, we had let me see, what was it? Turkey raised their rate significantly. I don't have the amount here. South Africa just raised their rate today. The repo rate is 5.5% in South Africa. Here it's, close to 0. So if you want to make more money, you can put your money in South Africa bank and make a higher interest rate. But they're doing that because they want to stem the flow of money out of their country, out of investments in their countries, which has been happening. And then, another interesting thing about this is they call these the Fragile Five. There are a lot of other emerging market countries that have very good balance sheets and are in very good condition, fiscally. So they're not all the same, I guess is what I'm trying to say. And then the money flows. I don't know if everybody's familiar with the term the Great Rotation. What that means is bonds, people selling out of bonds and buying stocks. Okay, so that's a rotation considered. And here, what we're looking at is we can see equity funds, the amount of money going in from November 2012 up through the end of November of 2013, and the dark blue line. But look at the bond fund line. Notice it's not below zero. There's still money going into bonds. It's just decelerated. Okay, not as much going in. So there's still a lot of money that can go into stock funds. You know, there's just been a trickle coming out really of bonds going into stocks. And can this propel valuations even higher? So the PE ratio, we call it the price earnings ratio. That's how we value stocks. So we take the price of the stock and divided by the earnings. So, you know, 18 times earnings, 12 times earnings, whatever it might be. That's how we come up with that figure. But the average of all periods has been 17.8. The average when rates are above 6% is 12 PE ratio. The average when rates are below 2.5 is 21.8. So we are not overvalued yet. We're not even at the average for when rates are so low. It's at 16.9 was the PE at the end of the year. Okay, we just haven't seen losses like this in a while, so people get freaked out about it, you know, but we've been due for a correction, you know. But in the long run, you know, these are looking at the averages in the long run, just like we saw that chart earlier with all the many more years of gains than losses, you know, something to keep in mind. But stocks will need, you know, sales to increase and earnings to grow in order to sustain the rally. But they are very far from any highs. You can see at the beginning of this chart, 1999 is the top one. Price earnings ratio was 31, you know. And actually it was even higher in 2009. It was at 20. It was the highest point for the PE ratio. And it's come down to 19 to 16, 15, back up to close to 17. You know, if companies keep making more money and their earnings keep increasing, then it's a natural thing for the prices to go up. And so here we have what this chart shows is sales growth estimates by sector. And we have healthcare. So these are the 2014 projections. Healthcare to be the biggest and consumer discretionary. Then technology, consumer staples, and so on down to energy being really low. Oh, there, the lowest expected. And then, of course, this year's an election year. And then we have the new debt ceiling coming. And then, of course, budget debates will be happening. So I thought this was interesting. If we go from this, what this chart's showing is anti-incumbency mood. So in other words, the lighter color are the number of voters that were surveyed saying, yes, they want to re-elect who's in there. And the darker is the one saying, no, they don't. So you can see how much closer they're getting to each other now in that last, for right now, the last bar. And this is interesting. Obamacare versus Affordable Care Act. So these are the CNBC surveys showed. But the problem is they're the exact same thing, and people are just confused about what it means. What this slide shows is what employers think that the Obamacare or the Affordable Care Act, whatever you want to call it, what will increase health care costs. So 61% think that their health care costs will increase, and 29% don't know, 10% think there's no increase. But I think what's interesting in the 61% is, you know, there's several that think it's going to cost, a bunch of them, less than 5%, you know, up to 3 to 4%. Now, you know, as a small business owner myself, I remember years when health insurance went up 10, 15%, you know, in a year. So, you know, if it increased a few percent, that's actually not that bad. So we'll see. I mean, we'll see what happens. We've heard a lot. I know the CEO of Aetna has been in the news threatening that Aetna is going to pull out because they're not getting enough young people in the plan and so forth. And I just think it's a lot of political posturing. So, you know, we'll just wait and see what happens. I think when Medicare was introduced actually back in the 60s, you know, there was a lot of hoo-ha about that too. And, you know, but over time that just becomes normal, you know, and this will probably end up being the same way, I'm guessing. But we'll see. I don't really have an opinion on it one way or the other. And then this slide's interesting because what it's showing is 80% of people are unaffected, really unaffected by it. And I know our rates for my husband's plan through his company didn't go up at all this year, you know, so at least what we pay didn't go up. And there are 14% that are uninsured, currently uninsured, who gain access. So, all right, geopolitical tension. So what do you think of our new ambassador to North Korea? Dennis Rodman. Yeah, pretty crazy.
I'm going to tell you a story from my highway patrol days. I simply call this my Christmas Eve. The hour is late, should go to bed, near midnight I believe. But memories keep me wide awake this snowy Christmas Eve. Yes, memories of my kids moved on, each has their separate life. And how the holidays have changed since angels took my wife. The toys, the food, the Christmas cheer. My wife would bear the load because I would work most holidays, state trooper on the road. Just sitting in my easy chair, so many years retired, I reminisce on times gone by and all that has transpired. Of all the many happenings that seemed to come to light, a multitude of them occurred right on this very night. A drunken woman in Iraq who died on Christmas Eve leaves memories of a tragic case most people can't believe. I had to drive to where she lived to tell her next of kin. Found the run-down mobile home she had been living in. The person answering the door, I still recall today, a little girl about 4 years old. She said, "I'm Sue McKay." I asked her if her dad was home and felt the longest pause. She said, "My daddy ran away." "You must be Santa Claus. My mommy said you'd come tonight if I just stayed in bed and bring a pretty doll for me." It's what my mommy said. I broke the law that Christmas Eve, did not call child's care. They'd merely put her in a room, and that I couldn't bear. I picked her up and took her home. My wife tucked her in bed and wrapped the pretty doll for her, just like her mommy said. Adopted by a loving home, and soon they moved away. I won't forget that Christmas Eve and little Sue McKay. Another bitter Christmas Eve, a blizzard to behold. Had left a family in the ditch, just trapped there in the cold. By grace of God, I spotted them all cold and gaunt with fright, drove them to a motel room to safely spend the night. One Christmas Eve, a homeless man, shivering and wet, was trying hard to get a ride I'm sure he'd never get. I picked him up and drove him to a diner on the hill to warm his bones and left him with a $5 bill. Strange how when you're all alone with memories you recall, you think of everything you've done. Was it worth it all? I think about my God, my job, my children, and my wife. Would I do it all the same? Could I relive my life? Then comes a knock upon my door. This late, who could it be? A neighbor? Or has Santa Claus come to visit me? The figure standing in the cold gives me a sudden fright. A trooper with that solemn look. Dear God, who's died tonight? I'm flashing back through bygone years and how I'd often stood on someone's porch to bring them news, and it was never good. Is this how life gets back at me? For misery I've induced, where pain I've caused some other folks has now come home to roost. But looking in the trooper's eyes, my mind is in a whirl. I see a pleasant countenance. The trooper is a girl. She smiled and reached to shake my hand, and silence wasn't broke until a tear rolled down her cheek, and then she softly spoke. "I'm sure you don't remember me, but thought I'd stop and say, God bless you on this Christmas Eve. I'm Trooper Sue McKay."
Yeah, so we'll leave us all with that, and yeah, just know that any kindness will always be remembered. Any kindness given. So, all right. Well, thank you everyone for coming. Yeah, it's great to be here.
I hope you enjoyed listening to Melissa Motz, and if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of the upcoming events. Visit our website at www.motzwealthmanagement.com for the most up-to-date listings of these events. Over the years, many of my clients have asked me to speak with a friend, relative, or colleague concerning private financial management. I consider it an honor and a privilege and have been happy to accommodate those wishes. For your future reference, I want you to be aware of the standards by which I comply with such requests. First, confidentiality is the cornerstone of my business. Each of my client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, I will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send me an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member of FINRA and SIPC. Melissa H. Motz is an investment advisor, representative. Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.